about, I don't know, 8, 10 years ago, I began to see things that didn't happen in my lifetime before, but happened in the 1930 to 45 period. And then I thought I better go back and study the rises and declines of reserve currencies. And so before the dollar, there was the British pound, and before that, there was the Dutch guilder. So I looked at these cycles, and you see the cycles, and I see we're in the cycle. There's a financial component to that cycle, which has to do with the creation of debt and financial assets, and then the limitations of that. And we'll get into that in a moment. Then there's an internal cohesiveness clash cycle that has to do about money too, which has to do with as the wealth gaps grow and the values gaps grow and political gaps grow, you have a greater amount of conflict. And then there's a third cycle that will all relate to each other. But the third cycle is the rise of a great power to challenge an existing great power, such as the rise of China challenging the United States. And they all sort of go together because, it comes down to basics. Are you strong? Are you strong economically and so on? So let me just fast forward on the financial part of that. The cycle is really that debt and credit creates buying power. And so it's a short-term stimulative and it's a longer-term depressant because you have to pay it back. And so every time an economy gets weaker, and so they jab it with credit and it pumps it up, but it accumulates this debt, so it rises. And they keep doing that until it becomes more and more difficult. So as you get down to something like a zero interest rate, it becomes more difficult. And also the pile of that debt is also the pile of somebody's assets. They own the bonds. They own the financial assets. And all of those financial assets are claims on real stuff, real goods and services. So when we think about money or storeholds of wealth, and you say, where is your wealth? We tend to define it as those financial assets, but those financial assets have no purpose other than to sell them to get the goods and services. And when the pile becomes very big and the incentives for not holding that are no longer there, you have a problem, okay? Because it's gone through history. You have those financial assets want to go to get the tangible assets. In the old days, that would be go get the gold or something. But when you go there, there's too many claims to get it. And then you have that problem. And inevitably, there's the printing of money. So we can think of the financial system. We'll start there before we get to the wealth gap and the other thing. You can basically see that the cycle that we're in, the New World Order, began in 1945 at the end of World War II. And that is when the United States won the war. These cycles happen this way. There's a conflict, there's a winner, and there's new rules of the game, and there's a new reserve currency, and that's the dollar. And the dollar was connected to gold. And it wasn't really, nobody thought of it as having any value. It was like checks in a checkbook, and the money was the gold. And so the little pieces of paper would go get you the gold. And that system then resulted in us spending. We had the privilege of the reserve currency that meant people want to lend to us. We would spend more than we earned. And those who got these dollars turned those dollars in to get their gold. And the gold stocks went down. And then in 1971, I remember it well because I was clerking on the floor of the New York Stock Exchange. Nixon says to the country, or says to the world in his very polite and diplomatic way, that you're not going to get the gold anymore. And so there was the devaluation and the printing of money, and we had the 70s and so on. So we're in a situation that's like that. We have the decline in, the decline in real rates, the pushing of a lot of liquidity out because there's not enough money, not enough hard money, but everybody needs more money. So we need that more money. So money is credit. You can make it up. So the government creates a lot of credit and the central bank prints a lot of money. And there's not much incentive to hold this money. Think about cash. If you hold cash, you get no interest rate, but there's an inflation rate that's, let's say, 2% a year, and then you have taxes and things. And if you think about bonds, there's not much incentive there, and, negative in some places. And so now we have a supply demand problem, okay? Because as you look at the budgets and you look ahead, we know we're going to need a lot more money, a lot more debt. And this is all the cycle. You need the more money. You have to print that. You need more money, so taxes go up, and that produces the dynamic. Now, I can keep going on about what happens in that dynamic. It may be capital controls. You start to go to things where that money wants to go someplace, and it goes to almost anything else. Particularly at all that time, I learned in 71, painfully learned in 71, that it causes like stocks to go up. It causes everything. We can deal with the mechanics of the stocks, gold, Bitcoin, real estate, everything to go up because it's really going down in dollars. And that's the part of the cycle we're in. First of all, there are two types of inflation. There's the supply demand inflation when demand is strong enough and it presses up against capacity, like you don't have enough labor, unemployment rates are low and capacity is low, and then prices go up, and there's that kind of inflation. And then there's a monetary inflation, which comes from the supply of debt being too much so that they produce more of the money, and the holders of those financial assets, particularly bonds, because bonds is just a promise to receive money that the central bank can print. The holders of that then go into those other things. And then what happens is then you just have to follow the money. So you see who gets the money. And then when they get the money, you see what they do with that money. So let's say if you change who gets the money now, because we're going to change that, taxes will change that, other things will change that. That goes then to those other people. So the inflation, the big inflations, the ones that are really most important are not the ones of the supply and the demand. They are the ones like that which followed 1971, my example. Okay, there's not enough money. You put it down, you devalue. In other words, you sever the link. And then with that, then there's a monetary inflation. You go into those other things, and then you have that. So the risk, let's say there's two risks. We will have a hell of a lot of demand because we put all that money in. Cash is all over the place. And even investments, all the investments go up because of so much cash. And how do you find a good investment? But also, there's so much money, and it'll change the amount that is in the hands of individuals and so on. And so now it's in cash, and that'll move on because cash is trash. I'd say that because it'll have that negative real return. The real risk, you'll experience more inflation. Right now, a lot of it is in cash, and there'll be a lot more money being produced. But you'll experience that more in that kind of inflation. Things will go up. You could see inflation in houses, inflation in, many things is going up. And then you'll start to see probably some labor inflation. If you start to see labor inflation and so on, it'll be a different kind of inflation, though, because we're in a more digital society. Those things can be produced. That supply of digitalization can be produced without the capacity constraint. But the big monetary inflation is the thing. Where do I store my wealth? Because what happens to the markets is then when you go to those other things, let's say you go to stocks, you go to real estate, you go to other things because they're getting out of that. As those prices rise, like a bond, their future expected returns go down. And as they come closer to the interest rate, so now you've got whatever the interest rates are, it depends on the country, but it comes down, then there's no longer the incentive to buy those things, and you could have trouble. And it becomes very difficult to tighten monetary policy because the whole thing falls apart. Everything's interest rate sensitive. And so the central bank has got to then print that. Then you have negative real returns in stocks and other assets, like we did in the 70s, but the nominal return goes up. That pattern has happened over and over. I'm just trying to describe the mechanics of it.